Interest rates. We're fascinated with them. Are they going up? Are they going down? Should I fix? Should I float? Have I done the right thing? If I fixed for a year, is it too long? Is it too short? Should I be fixing for 5 years? We're constantly worried about interest rates in New Zealand. But in my view, speculating about interest rates is a bit like trying to beat the house at blackjack. It requires a lot more luck and a lot more skill than most of us possess. In my opinion, the single biggest thing you can do is structure your home loan in the right way to reduce your debt as fast as possible. Let me show you what I mean. Let's take a $200,000 home loan. Currently, they're paying 6.85% over 30 years, which is about $1,311 a month. Now let's say they change banks and get a rate of 5.85%. That takes their repayments down to $1,180 per month, a saving of over $131 every month. Most people would be very happy with $131 per month in their pocket. I know I would. But the fact of the matter is, they are still left with a 30-year mortgage. Not to mention the rates are variable, so this saving will last only as long as the fixed term does. Somewhere between 6 months and 5 years, not for the entire term of their home loan. The problem with interest rates is that they are largely out of our control. One thing that we do have much more control over, and that can help us regardless of the current interest rate climate for the entire life of the loan, is the structure of your home loan. There are two key components to structure that will help you in the long run. The first is being able to use your income and savings to offset your loan balance and decrease your interest payments. There are several different ways to do this, each with their own pros and cons, but having this structure could save you tens or even hundreds of thousands of dollars over the lifetime of your loan. For example, using the same figures as above, with an income of $5,000 a month, and assuming that they spend all of their income each month, they'll save over $8,500 just by using their monthly income to offset against their home loan. If they saved $100 a month, not putting it into their home loan but having it in an account that's offset against their home loan, that figure grows to a whopping $67,000, and the loan is repaid 6 years earlier. The second is a home loan that gives you the ability to make extra repayments onto your loan, whether this be in the form of a little extra each month or a lump sum from time to time. For most people, having a portion of their home loan on a floating rate will allow them this flexibility. In this example, by paying just $50 extra per month, would shave over 3 years off the life of the home loan and save over $35,000 in interest. So to summarise, interest rates save $130 a month for between 6 months and a few years. Offsetting, save from $8,000 to $67,000 over the life of the loan and decrease the length of the loan from between 6 months to 6 years. And extra repayments decrease the length of the loan by a further 3 years and save $35,000 in interest. The numbers really speak for themselves. So there it is. The savings that can be made by having the right structure over the long term far outweigh the savings that can be made by lower interest rates over the short term. And structure is the one thing you have control over the lifetime of your loan.